Every economic collapse tells the same brutal story, just with different costumes. Ancient empires, modern nations, everyday investors, they all fall for the same invisible traps. When the system cracks, it doesn't just destroy wealth. It exposes the mistakes that were always there. Imagine waking up in a world where your savings suddenly mean less, your income slows down, and uncertainty spreads faster than panic. That's exactly what happened during past collapses, and it's happening again in new forms today. But here's the uncomfortable truth: most people don't lose wealth because of the crash itself. They lose it because of how they react. From ancient financial breakdowns to modern market crashes, the patterns repeat with eerie precision. And if you can recognize these patterns early, you don't just survive, you position yourself to win. Let's break down the 7 mistakes that silently destroy wealth every single time history resets. Mistake number 1, panic selling. The first mistake is the most emotional, and the most expensive: panic selling. When markets fall, fear takes control. Prices drop, headlines scream disaster, and people rush to sell, hoping to save what's left. But in reality, they lock in losses at the worst possible moment. Throughout history, those who sold in panic almost always regretted it. Why? Because markets move in cycles, not straight lines. What looks like the end is often just the middle of the storm. The real damage isn't the falling price, it's the decision to exit at the bottom. Smart investors understand that volatility is part of the game. They don't react emotionally, they act strategically. Panic selling turns temporary declines into permanent losses. And once you're out, getting back in becomes even harder because fear doesn't disappear, it lingers. So while the crowd runs for the exits, wealth quietly transfers to those who stay calm and think long-term. Mistake number 2, overleveraging. The second mistake is invisible until it's too late: overleveraging. Borrowing money to amplify returns feels powerful during good times. Profits grow faster, confidence rises, and risk seems manageable, until the tide turns. In every major collapse, leverage acts like gasoline on a fire. When asset prices drop, debt doesn't disappear. It tightens. Suddenly, investors are forced to sell not because they want to, but because they have to. Margin calls, rising interest rates, and shrinking liquidity create a chain reaction that wipes out entire portfolios. The danger of leverage is that it removes your ability to wait. And in a crash, time is your greatest asset. Without it, even the best investments can fail. Wealth isn't destroyed by bad assets, it's destroyed by bad structure. Those who survive crashes often follow one simple rule: never risk what you can't afford to hold through chaos. Because in downturns, survival always beats speed. Mistake number 4, lack of diversification. Chasing trends. 2 mistakes often work together to accelerate losses: lack of diversification and chasing trends. When times are good, concentration feels smart. People double down on what's working: a hot stock, a booming sector, a trending asset. It creates the illusion of control and brilliance. But when the cycle flips, concentration becomes fragility. One wrong bet can erase years of gains. At the same time, chasing trends means you're always late. You buy when hype is highest and risk is greatest. In every crash, the most crowded trades fall the hardest because everyone tries to exit at once. Diversification isn't about playing it safe, it's about staying alive. It spreads risk across different outcomes, ensuring that no single failure destroys everything. The goal isn't to predict the future perfectly. It's to be prepared for multiple versions of it. Because wealth isn't built by being right once, it's buoy. Mistake number 5, ignoring cash flow. The fifth mistake is subtle but deadly, ignoring cash flow. During economic booms, people focus on asset prices, stocks going up, real estate appreciating, portfolios growing on paper. But in a crash, paper wealth can disappear overnight. What matters then is not what you own, but what continues to produce income. Cash flow is the lifeline that keeps you stable when everything else is uncertain. Without it, even wealthy individuals can be forced into bad decisions, selling assets at low prices just to cover expenses. Throughout history, those who maintained strong, consistent cash flow had a massive advantage. They could hold their investments, buy opportunities, and avoid desperation. Cash flow buys time. And in any crisis, time equals power. Wealth that depends only on rising prices is fragile. Wealth supported by steady income is resilient. The difference between the two becomes painfully clear when the economy stops cooperating. Mistake number 6, following the crowd. The sixth mistake is psychological, following the crowd. Humans are wired for social proof. When everyone is buying, it feels safe to buy. When everyone is selling, it feels dangerous to stay. But in financial markets, the crowd is often wrong at the most important moments. Bubbles are built on collective excitement, and crashes are fueled by collective fear. If you follow the crowd, you inherit its timing, and its mistakes. True wealth builders think independently. They question narratives, analyze risks, and make decisions based on logic, not popularity. This doesn't mean always going against the crowd blindly. It means understanding when sentiment has become extreme. Because extremes don't last, they reverse. And when they do, those who stayed grounded benefit the most. The hardest part isn't knowing what to do. It's having the discipline to do it when everyone around you is doing the opposite. The final mistake is the one that ties everything together: lack of a long-term plan. Without a clear strategy, every market movement feels urgent. Every headline demands action. And every downturn feels like a personal crisis. But with a long-term perspective, volatility becomes noise instead of threat. The most successful wealth builders don't try to predict every crash. They prepare for them. They build systems, not reactions. They understand that downturns are not exceptions, they are part of the cycle. From ancient collapses to modern crises, the winners are not those who avoid every mistake, but those who avoid the fatal ones. Because wealth isn't destroyed in a single moment, it's eroded by repeated poor decisions under pressure. The good news: these mistakes are predictable. Which means they're avoidable. And if you can avoid them while others repeat them, you won't just survive the next crash, you'll come out stronger on the other side.